Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, Professor of Economics at the Catholic University of Korea. Professor Young, good afternoon. Thank you for making time.
Happy to be here.
Well, let's start with the markets last week. With the sanctions on Russia and all the uncertainty and possible disruptions those could cause, we see the Dow off for a fifth week in a row, the S&P and the Nasdaq off for a second week, tech shares taking a hit in particular. What's the story in the global markets on this Monday?
Okay, well, last week, the U.S. stock market rose on Wednesday based on reports that OPEC may increase production when the oil prices fell as a result. But on Thursday and Friday, it lost ground again, and on Friday, it lost for the Dow 0.7%, S&P minus 1.3%, and Nasdaq minus 2.2%, but it still is a bit higher than the low that the markets had on Tuesday. Now, why did it fall so much on Friday? Well, the U.S. announced that the U.S. will boycott Russian oil, but Europe and Asia can still buy Russian oil if they need to. There's still no ceasefire or progress in negotiations between Russia and Ukraine, so the fighting is now likely to become longer run. And then Russia is now in danger of defaulting on their international loans, though it did record a large trade surplus in February thanks to high oil prices, and it is also likely to have a trade surplus in March as well, but there's no easy way for Russia to take that trade surplus and use it to pay their debt. Oil prices, they seem to be stabilizing, though they're still high. West Texas Intermediate was up 2.9% at $109 per barrel. Brent was up 2.9% as well at $112 per barrel at Friday's closing. It rose on Friday, but still lower than the midweek highs that they had on Tuesday before the news that perhaps OPEC will increase their production. For the week, Dow fell by 2%. S&P fell by 2.9%, Nasdaq fell by 3.5%. Year to date, Dow fell by 10%, S&P by 12.4%, and Nasdaq by 18.9%. Europe, it was up on Wednesday following the United States, but it was down on Thursday, but up on Friday. Analysts are saying that perhaps the European investors are readjusting because it fell too much during the early part of the fighting in Ukraine. Asia, there was an uptick on Thursday following the U.S. rise on Wednesday, but generally a large downward trend for the week.
Right, and today Korean shares off too. Foreign investors, major sellers of Korean stocks recently and today, between the KOSPI and the KOSDAQ selling more than 1 trillion won worth. The currency's been weakening significantly too. Tell us about the domestic market.
Okay, well, there was an interesting report coming out on March 13th. That was Sunday by the Korea Exchange, which says that the foreigners are moving out of the Korean market for the last couple of months. The foreign share of the Korean securities market at the end of trading on Friday the 11th was 31.9%. That's the lowest since February of 2016, and it came down from 40% in early 2020. So why is the foreign share of the Korean stock market, securities market falling? Well, there's danger of rising interest rates in the United States and in Korea as well. Also, because of the situation in the Ukraine as well as possible default in Russia, there may be a flight to safety. And then the won is pretty set on depreciating. So even with perhaps more or less healthy returns, which the Korean stock market is not showing right now, depreciating won will make the value of the investment even lower. So that seems to be the reasons why foreigners are moving out of the market. And the Korean won reflected this. Korean won depreciated by 10.3 won today. It fell by 0.57%, and it hit 140 won. That's the weakest in 1 year and 10 months. KOSPI, it rose on Thursday, fell on Friday, and it fell today by 0.59%. It ended today at 2,645.65. For the week, it's down 1.9% last week, and year to date, it's down 11.5%. KOSDAQ and the individuals and institutions bought and foreigners sold. KOSDAQ, it rose on Thursday and Friday, but it fell today. It's down 2.16%, and it ended today at 872.44. Year to date, it's down 16%, and individuals bought and institutions and foreigners sold.
Well, as you discussed, Professor, the war in Ukraine has caused oil and gas prices to soar with the huge wave of sanctions put on Russia. When oil gets more expensive, it adds costs to all kinds of things that are manufactured and transported. Inflation has already been high in the sort of hangover from the pandemic. What do you see happening to the prices of consumer goods or otherwise?
Well, the price of consumer goods are still expected to be very high. The question is whether this will push up inflationary expectations, or whether the prices can be managed to go down before the people's inflationary expectations go up. The reason that this is so important is that if people's expectations of future inflation goes up, that will make inflation a lot longer and a lot higher. Now, currently, it does seem like consumers still expect high inflation to be temporary, lasting only this year, but they also have started to ask for higher wages in the United States, not only because of the labor shortage that they're having, but also because of the higher inflation. And this may be the beginnings of wage price spiral, and then the short-term expectations of inflation are rising further because of the Ukraine and the rise in the gasoline prices. So the Fed really needs to start increasing the interest rate, which they are expected to do at the FOMC meeting this week. Hopefully, the upcoming rise in interest rates will put dampeners on U.S. demand, which is acting as an engine, which is worsening the bottleneck situation that we're having in global supply and transportation. Now, there is a danger that if the U.S. raises the interest rates too quickly, it might spark off a recession and a stagflation. President Biden and the Fed do not think it's a likely scenario, but the financial sector is concerned. But some of the recent oil price rise is worrisome because that is what affects inflation expectation the most. But luckily, in the last couple of days, because of the rumors that OPEC may be increasing production, the prices have been falling a little bit. But OPEC is not committing to increase production because they're still watching out for watching out for Russia, scared what Russia may do if OPEC does increase production.
Well, it's the start of a new week, Professor. Coming up, we'll have Korea's export data for February. The Fed, it's generally agreed when it meets, is going to raise interest rates, most likely by a quarter of a percentage point. What's on your radar in the week ahead?
Okay, well, on Tuesday, we have a 2021 quality of life reports coming out from the government and export and import price index from Bank of Korea. Wednesday, this is a big one for Korea, the employment report. We'll see what the unemployment rate and employment rate is going to be. And then there's the money supply report by the Bank of Korea coming out on Thursday, as well as the household loans by deposit institutions. And we'll see how badly or how well the household loans are growing or falling. Foreign statistics, U.S. has producers price index coming out on Tuesday, and it has consumer retail spending figures coming out on Wednesday. But everybody's watching out for, as you said, the FOMC meeting on Tuesday and Wednesday, where they're expected to raise the interest rates by 0.25%. That is widely expected, but what people want to know at this point is how quickly the Fed is going to raise the interest rates, see if the Fed will give out any hints.
Got it. All right, Professor, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you.